Every time the crypto market takes a small step forward, the same question comes back again and again. Which projects are truly being prepared for the future, and which ones are simply surviving on hype? This question matters more today than ever before because we are now entering a phase where institutions are no longer experimenting, they are choosing. And when institutions choose, they don't look at emotions, trends, or social media noise. They look at structure, liquidity, and long-term usefulness. Welcome to BullionIQ. This channel is built for people who want to understand crypto from a real financial and institutional perspective. Here, we don't chase pumps, and we don't panic on dips. We focus on logic, data, and how smart money actually thinks. If you want clear explanations in simple English, without confusing jargon, you are exactly where you need to be. Today's discussion is important because we are breaking down insights coming directly from people who are deeply involved in crypto at an institutional level. This is not retail guessing. This is not influencer opinion. This is analysis based on how capital flows, how infrastructure is built, and how financial systems evolve over time. We are continuing a deep conversation that includes voices like Matt Hugin from Bitwise, Stephen McClurg from Canary Capital, and David Schwartz, the CTO of Ripple. In earlier discussions, the foundation was already laid. We heard about scale, about global usage, and about what happens when blockchain technology moves beyond speculation and into real-world systems. David Schwartz previously explained what true global scaling would look like for XRP. He talked about millions of users, billions of transactions, and an ecosystem where XRP is not just traded but actually used. He also discussed tokenizing real-world assets such as infrastructure, logistics, and physical systems that already exist in the global economy. This is a very important point because real assets bring real volume, and real volume creates real demand. Now, the conversation moves into something institutions care deeply about: what actually drives returns. This is where many retail investors get confused. They look for one big event, one announcement, or one piece of news that will suddenly change everything. Institutions don't think like that. They look for multiple forces working together over time. One of the first ideas discussed is that XRP's value is not driven by a single factor. It is influenced by adoption, liquidity, macroeconomic conditions, and financial positioning. When these elements align, value is created naturally. This layered approach is exactly how institutions evaluate long-term assets. Stephen McClurg brings up something that is rarely explained clearly to the public: the basis trade. In simple terms, this is a strategy used by hedge funds to profit from price differences between spot and futures markets. Over recent months, many crypto assets saw their basis trades collapse, which caused capital to leave certain ETFs, especially Bitcoin-related products. What is interesting is that XRP's basis trade has been holding up better than many other assets. This does not mean instant price appreciation, but it does mean that professional money managers still see value and opportunity in XRP. This is a strong signal that XRP is being treated more like a financial instrument and less like a speculative gamble. At the same time, Stephen makes it clear that short-term trading strategies are not the real story. Long-term fundamentals matter far more. And this is where Ripple's broader strategy becomes important. Ripple has been positioning itself not just as a blockchain company, but as financial infrastructure. One example of this is the acquisition of Hidden Road, now known as Ripple Prime. This platform is deeply connected to institutional finance, securitization, and capital markets. The goal is clear: bring real-world assets onto the blockchain in a way that institutions can actually use. When real-world assets move on to the XRP ledger, the network gains users, transactions, and liquidity. Institutions care about this because liquidity reduces risk, and reduced risk attracts more capital. This creates a cycle that strengthens the ecosystem over time. Another key topic that starts to surface is global liquidity. Across the world, central banks are easing financial conditions. Even though some regions move differently for local reasons, the overall trend shows expanding money supply. Historically, crypto assets that have strong infrastructure narratives tend to benefit when global liquidity increases. This does not mean prices go up in a straight line. It means that over time, assets aligned with real financial use cases are better positioned to absorb and benefit from incoming capital. This is why some analysts believe that the next few years could show clear separation between speculative projects and infrastructure-focused assets. All of this sets the stage for what comes next. We are moving from surface-level discussions into deeper analysis of why institutions are paying attention, how XRP fits into a fragmented global financial system, and why being different is not a weakness, but a strength. It becomes clear that XRP is not being evaluated in the same way as most other cryptocurrencies. Institutions are not asking whether XRP can pump next week or whether social media sentiment is bullish or bearish. They are asking a very different question. Can this asset function inside a global financial system that is fragmented, regulated, and politically divided? This is where XRP starts to stand out in a meaningful way. One of the biggest misconceptions in crypto is that one single stablecoin or one single blockchain will dominate everything. In theory, that sounds simple. In reality, it is almost impossible. Every country has its own currency, its own regulations, and its own financial priorities. A stablecoin is always tied to one fiat currency, which means it inherits the political and jurisdictional limitations of that currency. Institutions understand this very well. This is exactly why the idea of a neutral bridge asset becomes important. A bridge asset is not trying to replace fiat currencies or stablecoins. Its role is to move value efficiently between them. XRP was designed with this specific purpose in mind. It does not depend on one country, one central bank, or one financial system. That neutrality is not a marketing slogan. It is a functional advantage. David Schwartz, Ripple's CTO, addressed this point very clearly when responding to questions from a large creator who has been following XRP for more than a decade. One of the most common concerns raised was whether stablecoins would make bridge assets unnecessary. The answer was simple but powerful. If one stablecoin controlled the entire global market, then yes, a bridge asset would not be needed. But that scenario is unrealistic. Each stablecoin is stable relative to only one fiat currency. It also carries regulatory and geopolitical risk. Because of this, the future is far more likely to be a multi-stablecoin world rather than a winner-takes-all system. In such an environment, moving value between different stablecoins, tokenized assets, and financial products requires something neutral, liquid, and interoperable. This is where XRP's long-term thesis becomes stronger, not weaker. The growth of stablecoins does not threaten XRP. It increases the need for it. More stablecoins mean more pairs, more corridors, and more complexity. Institutions do not want to manage thousands of direct connections. They want efficiency, and bridge assets provide that efficiency. Another important aspect institutions look at is transaction speed and cost. In global finance, time is risk and cost is friction. XRP transactions settle in seconds and at extremely low cost. This is not just a technical feature. It is a financial advantage when dealing with large volumes and cross-border flows. Over time, these efficiencies translate into real savings, which institutions care deeply about. Interoperability is also critical. Financial markets are moving toward tokenization of assets such as bonds, equities, commodities, and even loan portfolios. These assets will not all live on one blockchain. They will exist across different systems, platforms, and jurisdictions. A bridge asset that can interact across these environments becomes increasingly valuable. This is why Ripple has focused so heavily on working with regulators and financial institutions rather than avoiding them. While this approach was criticized in earlier years, it is now proving to be strategically sound. Institutions prefer clarity over chaos. They want assets that can operate within regulatory frameworks, not against them. At the same time, market behavior continues to reveal a gap between retail emotions and institutional actions. Small price dips often trigger fear among retail investors. However, on-chain data consistently shows accumulation during these periods. Large wallets tend to increase their holdings when prices move sideways or pull back slightly. This pattern has repeated itself across multiple market cycles. Accumulation is not a guarantee of immediate price movement, but it is a sign of confidence. Smart money does not chase green candles. It builds positions quietly when attention is low and sentiment is mixed. This behavior aligns with what we are currently seeing in XRP's on-chain metrics. Another layer to consider is market structure. Market makers play a role in providing liquidity, but they also influence short-term price movements. By pulling liquidity or increasing volatility, they can create fear and shake out weak hands. This is not conspiracy. It is how markets function. Those who understand this tend to focus less on short-term noise and more on long-term positioning. All of these factors suggest that XRP is being positioned for a financial system that is becoming more complex, not simpler. Multiple currencies, multiple stablecoins, multiple tokenized assets, and multiple jurisdictions all point toward the need for efficient value transfer mechanisms. The institutional interest in XRP is becoming more tangible. We've already seen the beginning of this through partnerships, acquisitions, and ETF launches. Institutions are not just interested in buying XRP as a speculative asset. They are looking at how it fits into the broader infrastructure of global finance. This includes tokenized assets, cross-border settlements, liquidity provisioning, and collateral management. Each of these areas shows the practical use cases that differentiate XRP from other cryptocurrencies. One notable example is the acquisition of Hidden Road by Ripple, now rebranded as Ripple Prime. Hidden Road specializes in asset tokenization and financial infrastructure. The idea is simple but powerful. Real-world assets like bonds, container ships, or even cell phone towers can be represented on the blockchain. This opens new markets for XRP because every time value moves between these tokenized assets, a neutral liquid bridge like XRP is needed to facilitate the transaction efficiently. This is not theoretical. Institutions are actively exploring these use cases, and that adoption will have a compounding effect over time. Another key development is the focus on stablecoins like RLUSD. While Tether and USCD were the first movers and captured significant market share, newer stablecoins like RLUSD are gaining traction because they combine speed, low cost, and compliance features that appeal to institutional players. Compliance is a critical factor for institutions. They cannot use assets that could create regulatory exposure. XRP, combined with compliant stablecoins, provides the infrastructure they need. This is why some digital asset treasury companies are actively building portfolios and yield strategies centered on XRP. It's also important to highlight the architectural differences that make XRP appealing. Institutions often prefer diversified approaches rather than a single system. XRP's network design, stability, and neutrality differentiate it from other blockchains. Investors who understand tech and financial architecture see value in having XRP as part of a diversified portfolio of digital assets. This is similar to how consumers choose different brands of phones or cars based on their unique advantages. XRP offers a unique design that solves specific financial problems. Cross-chain interoperability is another critical factor. As more assets move on and off the XRP ledger, the ability to bridge between blockchains like Solana, Ethereum, or Layer 2 networks becomes increasingly important. Tools like wrapped XRP or protocols that connect different ecosystems allow value to move seamlessly. When XRP is locked in other networks for these purposes, the circulating supply decreases, which can positively impact price. This creates a feedback loop where adoption drives liquidity, liquidity drives institutional trust, and trust encourages further adoption. Exchange-traded funds growth also plays a significant role. XRP ETFs not only allow institutional investors to participate, but also provide a proxy for liquidity and price discovery. More liquidity in ETFs contributes to better price transparency and reduces volatility in the underlying spot market. Historical examples from precious metals ETFs show that investor participation in these products often leads to direct ownership and engagement with the physical or digital assets themselves. This trend is mirrored in crypto, reinforcing XRP's role as a foundational asset. Looking forward, several milestones will be critical for XRP's institutional adoption trajectory. The expansion of RLUSD and other stablecoins, growth in tokenized asset transactions, real-world deal flow, and the increasing number of ETFs are all metrics to watch. Additionally, collateral management and lending applications built on XRP will further embed it in financial workflows. As these systems develop, institutions will increasingly rely on XRP not just as a bridge, but as a core component of global financial infrastructure. Another interesting aspect is the creation of stablecoins and other currencies on the XRP ledger. Examples include euro-backed stablecoins and real-backed stablecoins. This global diversification reinforces XRP's role as a neutral bridge. When multiple currencies are represented as stablecoins and XRP sits at the center as the connecting asset, the efficiency of cross-border transfers and liquidity allocation is maximized. Finally, it's worth noting that growth is not just about technology or financial architecture. It's also about ecosystem maturity. Ripple is not only building the ledger, but fostering an ecosystem of developers, projects, and institutional participants who interact with XRP in meaningful ways. Whether it's collateral, settlement, or bridging liquidity across chains, the combination of adoption, partnerships, and strategic infrastructure is positioning XRP as a central asset for the emerging digital financial system. Liquidity and cross-chain interoperability are shaping the institutional landscape for XRP. ETFs are not just a product, they are a gateway for institutions to enter the crypto space in a structured and regulated way. Each new XRP ETF increases overall liquidity, which benefits the spot market. More liquidity means tighter spreads, better price discovery, and less volatility. This is crucial for institutional investors who often shy away from assets that cannot provide accurate pricing and predictable market behavior. The growth of ETFs also attracts additional participants who may simultaneously invest in XRP directly, not just through ETFs. This creates a compounding effect. The ETF increases demand, liquidity improves, and more investors gain confidence in holding XRP. Historical parallels can be drawn with gold and silver ETFs. Early ETF adoption in traditional markets often drove long-term growth in both investment and physical ownership. In the crypto space, XRP is following a similar trajectory, where institutional engagement via ETFs amplifies network participation and adoption. Cross-chain interoperability plays a complementary role. XRP is not limited to its native ledger. Wrapped XRP allows it to operate across different blockchains such as Solana, Ethereum, and Layer 2 networks. This means XRP can act as a universal bridge, facilitating seamless transfers of value across ecosystems. For institutions, this interoperability is essential. They need to move assets between networks efficiently, maintain liquidity, and optimize capital allocation. Every time XRP is used in these cross-chain transactions, it reinforces its role as a bridge asset while simultaneously reducing circulating supply, which can positively impact market pricing. Institutional adoption also extends beyond trading and speculation. Companies are beginning to use XRP for treasury operations, collateral management, and liquidity positioning. The ability to pledge XRP as collateral, settle cross-border transactions instantly, and interact with tokenized real-world assets sets it apart from other cryptocurrencies. By providing both stability and neutrality, XRP allows institutions to manage complex financial operations without relying on multiple intermediaries. This efficiency is increasingly attractive as regulatory compliance becomes a major factor in institutional decision-making. We also see the importance of stablecoins in this ecosystem. While Tether and USDC paved the way, RLUSD and other new stablecoins provide cost-efficient, secure, and compliant options. These stablecoins rely on a neutral bridge like XRP to facilitate interoperability across different networks and assets. For instance, cross-border remittances, real-time settlement of tokenized assets, and institutional liquidity pools all benefit from XRP's presence as a neutral and jurisdictionless asset. This combination of stablecoins and XRP infrastructure significantly enhances the efficiency and reliability of emerging digital financial systems. Another dimension is the architectural uniqueness of XRP. Unlike other blockchains, XRP offers an innovative protocol that is designed specifically for fast, cost-effective, and scalable value transfer. Institutions appreciate the differentiation because it allows them to include XRP as part of a diversified portfolio of digital assets. Just as tech-savvy investors diversify between Android and iOS devices or different cloud services, institutions are diversifying across blockchain architectures. XRP's distinctive design and proven use cases make it an attractive option for both treasury management and strategic financial planning. Real-world asset tokenization is also a critical driver. Ripple Prime, formerly Hidden Road, is actively working on bringing tokenized assets like corporate bonds, container ships, or telecommunications infrastructure onto the XRP ledger. Every tokenized asset introduces a new layer of transaction volume and requires a reliable bridge. XRP's liquidity and speed position it as the ideal asset for bridging these transactions. As more real-world assets go digital, the demand for XRP is likely to grow in tandem, creating a strong long-term growth story. Institutional players are also watching global monetary policies closely. Central banks in some regions are lowering rates and injecting liquidity, while others, like Japan, are experimenting with a combination of stimulus and rate hikes. This dynamic creates opportunities for XRP, as increased global M2 money supply often finds its way into liquid and innovative assets like XRP. Hedge funds and asset managers are increasingly considering XRP not only as a speculative instrument, but also as a component of global liquidity management. Finally, the ecosystem effect cannot be underestimated. Projects like Doppler Finance, Flare, and Uphold are expanding DeFi capabilities on the XRP ledger. The integration of XRP across multiple platforms, wrapped tokens, and new stablecoins builds an interconnected financial network. This ecosystem growth drives both adoption and value creation. Institutions can now access a diversified set of tools and products built on XRP, increasing the utility of the asset while simultaneously boosting confidence in its long-term viability. It's important to tie together everything we've discussed so far and focus on the potential milestones and future trajectory for XRP. One of the most significant drivers will be the expansion of stablecoins on the XRP ledger. We've already seen RLUSD gaining traction, and now other stablecoins tied to major global currencies such as the euro, Brazilian real, and yen are coming into play. When XRP acts as a neutral bridge between these stablecoins, it effectively becomes the backbone of cross-border digital finance. This will increase transaction volume, boost liquidity, and further cement its role as a critical financial infrastructure asset. Institutions are watching these developments closely. Treasury departments, hedge funds, and asset managers are evaluating XRP not just as a trading asset, but as a functional tool for liquidity management and settlement. XRP's speed, low transaction cost, and interoperability with other networks make it an attractive choice for real-time global transactions. Moreover, initiatives like Evernorth are actively using XRP for treasury management, yield generation, and market integration, showing that XRP is moving beyond theoretical use cases into real-world adoption. Tokenization of real-world assets is another transformative trend. Ripple Prime, along with other ecosystem projects, is creating mechanisms for tokenized securities, loans, and corporate assets to exist on the XRP ledger. Each new asset tokenized increases demand for XRP as the bridge to facilitate transfers and settlement. Over time, this builds a strong network effect where XRP becomes indispensable for institutions engaging in diverse financial activities. The cumulative effect of ETF adoption, stablecoins, and tokenized real-world assets positions XRP as a central pillar of the emerging digital financial system. Another key aspect to consider is liquidity and price discovery. ETFs, institutional adoption, and cross-chain interoperability all contribute to more accurate market pricing. This is essential for attracting long-term investors. As liquidity grows, volatility decreases, creating a more predictable environment for institutional participation. Retail investors also benefit because a healthier, more liquid market reduces manipulation risk and improves confidence in holding XRP over the long term. The combination of liquidity, use cases, and interoperability creates a reinforcing cycle that supports both adoption and value growth. Looking forward, key milestones for XRP include continued ETF proliferation, growth of tokenized assets, expansion of stablecoins on the ledger, and wider institutional participation. Each of these milestones contributes not only to network growth, but also to broader acceptance of XRP as a functional asset. As adoption expands across industries from payments and remittances to collateral management and enterprise treasury operations, XRP's utility will grow, solidifying its long-term relevance. The architectural uniqueness of XRP also cannot be overstated. Unlike other blockchains, it provides a neutral, scalable, and high-speed bridge for value transfer. Institutions are increasingly recognizing the importance of including diverse architectural designs in their portfolios. XRP's design, combined with the expanding ecosystem, makes it a differentiated asset that provides value beyond speculation. It allows investors and institutions to participate in a new financial infrastructure that is global, interoperable, and highly efficient. In conclusion, the future for XRP looks promising. The combination of ETF growth, real-world asset tokenization, cross-chain interoperability, and institutional adoption creates a multi-layered growth narrative. For retail investors, the message is clear. Understanding the fundamental utility of XRP, holding strategically, and monitoring developments in stablecoins, ETFs, and institutional usage can provide significant advantages. For institutions, XRP offers a scalable, interoperable, and efficient bridge for global financial activity. Overall, the XRP ecosystem is evolving rapidly. The integration of stablecoins, tokenized assets, and enterprise solutions, coupled with strong liquidity and architectural differentiation, points to a future where XRP plays a central role in global digital finance. For anyone interested in the cryptocurrency space, this is a moment to pay attention, understand the fundamentals, and recognize how strategic adoption of XRP could provide opportunities for both growth and innovation. BullionIQ will continue to track these developments closely, providing expert insights to help both retail and institutional investors navigate this exciting and rapidly changing market.